Okay, everybody, let's go ahead and get started. We're going to pick up where we left off last time, which is these parameters right here. So the last week we talked about the importance of 3,900 versus 4,120. Above 4,120, and the odds start favoring that this was a meaningful low and we're starting some kind of bigger uptrend. Below 3,900, and it opens the door to 3,500 being a higher probability. And so we broke below 3,900. We hedged going into the CPI reading, and then we hedged on that break below 3,900 and started covering it down here. So hopefully you've been able to follow us to some degree to get some kind of a gain in this terrible market. And I'm going to go over what I want to see that would cause me to put the hedge back on. And what I want to see that would have me start favoring that some kind of a low is in place. Okay. So we'll keep it pretty simple in terms of levels. These black lines right here, these are very important support zones. And I'm expecting a low to be met at one of these. Right now, we're at the first one, which is 3760. And there's just a lot going on right here, which is another one of the reasons why I took off. I reduced our hedge for a pretty nice little gain down here. Is not only do we have this confluence zone right here of supports, but whenever you look at the angles that this bear market is tracing, let me show you this right here. All I'm doing is taking the angle from each top, then duplicating this angle and placing it at these gaps. Gaps are incredibly important when it comes to how future swings will define themselves. So always mind those gaps, but I'm just placing these angles at these gaps, and you can see how important the angle is from those gaps right down here. I did the same thing right here at this gap. You can see how important it was right here. These two tops right here, and we're right on this angle right here. So not only are we on this confluence zone, but we're touching this angle right here that really has been pretty powerful going back in this bear market. And the other reason why is we're seeing on the daily chart a really strong divergence right here. So price is going lower. Our momentum indicator is actually going higher. And this oscillator right here, I use this is the D-trend oscillator. It's incredible in terms of defining support and resistance. This level right here was the level that caught the 2008 extreme reading, as well as the 2018 extreme reading. And so we're on very strong support here, divergences, multiple supports right here. So that's one reason why I wanted to remove our hedge for a nice gain and see how the market reacts at this level. And so what I'm looking for in order to say that this is some kind of a meaningful low is we want to see 5 waves off this low that breaks above 3,908. Last week, the main resistance was 4,120. This week, it is 3,908. So that's what we're looking for. And if we get 5 waves through this level right here, you're going to start seeing us get quite aggressive on the long side. However, let's say that we just have a weak 3-wave bounce that fails below here. You're going to see us go 100% hedged and putting a stop at this 3,908 for that hedge. So we're going to have very kind of a good risk reward for that hedge if we do see a 3-wave bounce that fails underneath 3,908. Okay, so these are the levels that matter. That's basically the game plan that I'm telling you right now. And now we'll get into what these counts could be tracing, what it would look like. So we'll start with the bullish one. And there we go. So let's assume that we hold this 3,760 area and we get that 5-wave move that breaks above 3,908. And this is going to be my primary right here. And that is that the June low was a major low and that we're tracing an uptrend. Unfortunately, it would have to be an ending diagonal pattern, which is an overlapping, messy uptrend. But we'd be entering the 3rd wave of that pattern. So it would be a really nice move probably into 2023 if that plays out. So that's what we'd be looking for if we get a 5-wave push off the low that breaks above 3,908. Okay. On the other hand, let's say that we just continue lower below 3,760. two things would be playing out. The only way that I can really count this in a bullish stance would be if we're tracing what I call a pretty complex correction, a WXYZ. Without getting into that, these are very rare. I've actually never seen a bear market on this degree in the S&P 500 that's traced this pattern. But it's the only way that it would make sense to me, considering how wavy and overlapping this is, really. So that could either be, if we could maybe get a double bottom just below there, then you could count this as a very complex and deep fourth wave with an uptrend into 2023. However, it also opens the door to us being in just finishing up the first leg in a much bigger bear market that would likely last through 2023. Either way, what you'd be looking at is at minimum a bounce probably into the end of the year that would take us back into the 4,000 range, at the most 4,300 range. So even if we do get this scenario right here, we still would have probably an end of year rally that would probably take us back up into this range, which would allow a lot of people to, de-risk, just breathing room to do whatever it is you want to do. It also opens the door to this being the major top, the beginning of a secular bear market that could last 8 to 10 years. And that's about how long secular bear markets last. And I know that probably scares a lot of people. However, secular bear markets don't go down in a straight line. And I'm going to show you what I mean by this. The last secular bear market we had was 2000 to 2009. And so if you look at the 2000 bear market, it basically played out. All corrections, no matter what degree, a 5-minute chart or a year-long chart, are going to take the form of a corrective pattern. This one was what we call a zigzag. 5 waves down is your A wave, a weak B wave, followed by 5 waves down and your C wave. So that was your A wave down, followed by the bull market in 2004, 2005, right? We had an A, B, C, which was your B wave, double top, followed by a 1, 2, 3, 4, 5, pretty devastating C wave that took you to new lows. This pattern right here is as clear of a flat as I've ever seen one. And a flat pattern is just basically, you got 3 waves down, 3 waves up, 5 waves down. But what I'm trying to tell you, in the secular bear market, over a 10-year period, the market didn't go anywhere. It actually went lower, right? However, you did have a multi-year bull market within that pattern. And so that's what you'd be looking for. So worst case scenario, let's say that we get some kind of A wave here, we get a multi-month B wave, and then a C wave down to 2023. That would be suggesting that 2024, 2025 would be a bull market. And we expect to be fully in line with our hedge before year end, which is going to really help all of our risk management. So anyway, I just want to show that we're still not there yet. We're still not at new lows. If we do break to new lows, then we start opening the door to this being a potential right here. Okay. But even in that scenario, we'd be expecting a multi-month bounce to de-risk any positions you would like. Okay. So moving forward, I do want to point out the interesting fact that the 3-month and 10-year spread widened yesterday. I find that to be very interesting, right? The Fed got more aggressive. They're talking about 75 basis point raise, followed by a 50 basis point raise, right? They're raising their target rate hike in this cycle, and you're seeing the spread widen right here. What you're basically seeing is, it seems like the bond market isn't quite buying it. You're seeing the bond market saying that they're going to break something before they reach their target goal, and they're going to be forced to drop rates back to zero. But interestingly, we've talked about how the 10 to 2 year spread, when it inverts, which is what this red line is showing, it typically is telling you a recession is on average a year and a half from the inversion, and it doesn't have a 100% hit rate. There have been 2 times where it gave you a false positive, to where the 3-month to 10-year, when it inverts, it gives you about a 1-year average time, like lead time, and it has a 100% accuracy in predicting a recession coming, and it has not inverted yet. And so the bond market isn't fully in line with an imminent recession. And I know some people may say that we're in a recession right now. However, this would be the first recession where, we've seen 400,000 jobs created per month and industrial production growing by 5% and manufacturing as well as services expanding in a recession. When we're in a recession, there will be no debate whatsoever. Everyone will know that we're in a recession. And that's what we're looking for right here. So the bond market hasn't fully priced in an imminent recession, which I find to be very interesting. And another reason why I might be leaning towards this blue count playing out right here, right, where this is some kind of a meaningful low playing out, is if you look at what's going on in the bond market and with rates. So rates have been one of the main catalysts for this equity bear market that we're in, right? So as inflation has gone up much higher than people expected, it has forced bonds to get repriced. No one wants to own bonds in an inflationary market. They do really well in a deflationary market. And as bonds get sold, rates go up. And as rates go up, that hurts equities, specifically growth, right? And what we're seeing is from the March peak, a very clear A, B, C wave in long dated bonds. And this C wave is playing out in a very classic fashion: 1, 2, 3, 4, 5. With these fifth waves, you want to see them happen. You want to see price go lower on less volume and less momentum. This is a classic 5-wave pattern right here. And we are right within this buying zone. So think about this. I mean, this is a very classic pattern, A, B, C right here. And so if this is accurate, what it's suggesting is that this would be the end of a large degree A wave, and what should follow is a large degree B wave that I think would take us back up into minimum 129, maximum 145. It could go even higher, actually. I would say more than likely targeting 137, 145. So that's a really nice move in bonds, which would push rates lower. Now, typically with B waves, they're at least half the length of the A wave, right? And so this was a 3-year downtrend in bonds. That would suggest that we get at least a year longer in an uptrend in bonds, which would push rates down. That to me lines up with some kind of bigger uptrend in equities, right? As rates are going lower, you would see some relief in equities, especially since rates were the primary catalyst for this bear market. So it's suggesting some kind of an uptrend in bonds through 2023. So that to me makes a lot of sense. And the other supporting markets we're looking at, oil continues to behave, right? I mean, we are expecting some kind of fifth wave push, but I have zero problem with this downtrend continuing longer, or maybe just going sideways for a long period of time. But it continues to stay low. And as it stays low, the inflation numbers should be representing the inflation numbers. We continue to see manufacturing data coming out, pricing data coming out, saying that inflation is calming down. As rates are going up more, housing is going to calm down. So we should be seeing some kind of improvement within the inflation numbers. And the other supporting market is the dollar. Now, the dollar continues to disappoint. We've had multiple attempts to break below 107. The bears couldn't actually follow through, followed by a new high. Couldn't follow through, new high. The good news about these new highs is they are being done on significantly less momentum. One of my favorite patterns, this was actually the pattern, one of the primary patterns we used to get out of the top of Bitcoin, was when you see this 3 kind of hump uptrend followed by a 3 hump downtrend in momentum. And we have that 1, 2, 3 right there. And you can see the RSI continues to support decreasing momentum as well. So eventually this is going to let go. The targets I have is 112 above, and the blow off top is the 115 level. But it's lining up on a macro level as well, especially considering that Europe is having to get very aggressive on fighting inflation, to where, even though we're having to get more aggressive than anticipated, we are seeing an end in sight to peak rate hikes. It was announced yesterday, if you read between the lines, it went from 75 to potential 50 basis point increase in rate hikes. to where last report it was, who knows how long we were doing 75 basis points. So anyway, I think the supporting markets are actually suggesting that we could be seeing some kind of meaningful low sooner than later, especially what's going on in the bond market. I do want to point out the inflection points. We talk about these time factors all the time. And the reason why we do that is because they have been incredibly accurate. They're actually the reason why we were able to, when everyone was saying that CPI is going to come in low and the low was in, we started putting on our hedge right here because it was right in the middle of a time factor. We were trending hard up into a time factor. And the way that these time factors work, there's cycles that cluster together. They give high probability turning points. And if we continue lower into this next time factor, which starts really next Wednesday, that's going to be another reason why we could be seeing some kind of meaningful low being put in. All right. So just keep that in mind. Next week is going to be important. Wednesday is when the next time factor starts. We're going to have to see how we're trending going into that. Okay. So we're going to talk about the FANGs.